Every time Washington talks about tariffs or a government shutdown, markets react before politicians finish their sentences. In 2025, that reaction is louder, faster, and more emotional than ever. But behind the headlines, there is a deeper truth most people are missing, and it directly affects your money, your job, and the future direction of the US economy. Let's start with tariffs. On the surface, tariffs are sold as a simple idea: protect American industries, punish unfair trade, and bring manufacturing back home. In reality, tariffs function like a hidden tax. When the US places tariffs on imports, companies rarely absorb the full cost. Instead, those costs move through supply chains and land on consumers in the form of higher prices. In 2025, with inflation still fresh in everyone's memory, tariffs are no longer an abstract policy debate. They are a cost of living issue. What makes this year different is timing. Tariff discussions are happening while businesses are already under pressure from higher wages, tighter credit conditions, and slower consumer demand. When tariffs rise in that environment, companies face a difficult choice: raise prices, cut jobs, or delay investment. None of those outcomes are good for economic growth, and markets know it. That's why tariff headlines now move stocks, bonds, and even the dollar within minutes. Now layer in shutdown politics. Government shutdowns used to feel like political theater, noisy, disruptive, but temporary. In 2025, the stakes are higher. The federal government is carrying massive debt. Interest payments are consuming a larger share of the budget, and investors are watching Washington's ability to function more closely than ever. A shutdown today doesn't just delay paychecks or slow services, it sends a message about governance risk in the world's largest economy. When shutdown threats emerge, consumer confidence drops almost immediately. Households pull back spending, businesses delay hiring, and markets price in uncertainty. Even if a shutdown is avoided at the last minute, the damage is already done. The economy runs on expectations, and constant political brinkmanship weakens those expectations over time. Here is the uncomfortable truth most politicians want to say out loud. Tariffs and shutdown politics often serve short-term political incentives, not long-term economic health. Tariffs create a visible tough stance, while shutdown showdowns energize political bases. But the costs are spread quietly across millions of consumers, workers, and investors. That makes them easier to ignore until growth slows or markets crack. In 2025, this dynamic is colliding with a fragile global environment. Supply chains are still restructuring, geopolitical tensions remain high, and global demand is uneven. The US economy is not operating in isolation. When tariffs disrupt trade or shutdowns threaten stability, global investors reassess risk. That can mean capital flowing out of US assets, higher borrowing costs, and increased volatility across financial markets. So who actually benefits from this cycle? In the short term, certain protected industries may see relief, and politicians gain leverage in negotiations, but over time, the broader economy pays the price. Small businesses face higher input costs, consumers see prices rise, workers experience slower wage growth or job uncertainty, and investors deal with choppier markets and reduced clarity about future policy direction. This is why 2025 feels different from past years. Markets are no longer dismissing these issues as noise. Bond yields react. Equity valuations adjust. Even credit markets are starting to price political risk more explicitly. The message is clear. Economic fundamentals cannot fully offset policy uncertainty forever. For everyday Americans, the takeaway is not panic, it's awareness. Understanding how tariffs and shutdown politics influence inflation, employment, and markets helps you make better financial decisions. Whether you're investing, running a business, or managing household expenses, policy risk is now part of the equation. Looking ahead, the most important factor won't be whether tariffs exist or shutdown threats appear. It will be whether policymakers signal stability, predictability, and a credible long-term plan. Markets can adapt to almost any policy, but they struggle with constant uncertainty. Until that changes, expect volatility to remain a feature not a bug of the US economy in 2025. If you found this breakdown useful and want clear, no hype explanations of what's really driving the economy and financial markets, make sure to subscribe to the channel. We break down complex economic stories into simple insights so you can stay informed, ahead, and prepared for what comes next.